Hi, I'm Cody Koch. Welcome to the channel. This video is part of my question and answer series videos in which people ask me questions and I give them answers. Let's get to it. Cody, what does cash flow mean when you're looking at buying a business? Cash flow has actually become somewhat of a broad term, and the definition of cash flow varies, I've found, from one person to another. And so when somebody says a business makes, let's say, $1 million a year in cash flow, I have to ask them how exactly do they define cash flow? Because it can vary a little bit. It can vary by industry, it can vary by brokerage firms, or even investment banks. For me, cash flow means how much can we put in our pocket after everyone's paid and after we have assured the capital structure is complete. In other words, we have enough capital for inventory, enough capital for accounts receivable, enough equipment, and equipment's in proper working condition, and so forth. So out in the world, you actually find there's three major ways to shorthand value cash flow. The most prominent is what's called EBITDA, or earnings before interest, taxes, depreciation, and amortization, or EBITDA. The idea is that it's a simplified way to get a hold of cash flow, and that's used as a way to kind of simplification tool within business acquisitions and businesses in general to kind of give a rough idea of what cash flow really is. But again, we have to go and adjust them fully to really be able to hash out what true cash flow is. The big problem with EBITDA is that if a business has a lot of, let's say, depreciation, which is very common in, let's say, manufacturing businesses or even real estate businesses, EBITDA is not a very good measure because depreciation is a real world expense. The issue with that is that by taking out depreciation, it's not showing the real world rough example of what's actually likely going to be the case running and owning that business in the future, simply because depreciation is a major estimate of how much capital expenditures would be required in order to keep the business held together over time. So typically EBITDA I have found to be better measure of cash flow in the case of service businesses, and that is businesses that do not have a lot of capital expenditures, they don't have a lot of equipment, they don't have a lot of things that can break down and have to be repaired. The second most common is EBIT, earnings before interest and taxes, EBIT. It's typically used in industries that have a lot of capital expenditures. So that would be in the case of manufacturing, real estate, or even trucking businesses, for example, in which a large amount of capital expenditures have to be spent on a regular basis. That's what the depreciation sort of tracks over time, is the maintenance, what's called the maintenance capital expenditures of all the equipment and everything in the business. Let's say you buy a fleet of trucks. Let's say you have 15 large semi-trucks, for example. These semi-trucks need repairs on a regular basis. They need new engines, new tires, and various things in order to keep them up over time. The depreciation expense on the books for a trucking company, let's say, is a very good measure of how much capital expenditures would need to be required on a regular basis in order to keep up that business going forward. In fact, in many cases, depreciation is often a little bit too low, and so you have to put some kind of premium on it in your estimates in order to assure that the capital expenditures will be able to be covered from your cash flow. If we do not properly adjust for the capital expenditures that are going to be required in these businesses, then we have an issue in which the business will not actually be able to produce the cash flow we originally assumed and our estimates of value of the business are based on. And as a quick note, there are two types of capital expenditures. There's maintenance capital expenditures and there's growth capital expenditures. Maintenance capital expenditures are the capital that you have to spend to repair, upkeep equipment, or buy equipment to replace broken down or old equipment. Growth capital expenditures are the capital expenditures that go towards anything that should add revenue in the future. For example, in the case of a trucking business in which we have a fleet of 15 trucks, for example, if we went to buy a 16th truck in order to grow the business, that 16th truck would represent a growth capital expenditure. All these capital expenditures end up on the income statement under a depreciation expense. So we have to be careful with this because depreciation expense represents a true money out of pocket kind of scenario. So we have to be careful which form of cash flow representation we use, EBITDA or EBIT. So the last one is we have SDE, or seller's discretionary earnings. Now, seller's discretionary earnings is typically used for businesses that make less than $500,000 a year in earnings. Seller's discretionary earnings is an odd term, but basically you take EBITDA and you add back the manager's salary to that number. So it makes the EBITDA number a little bit higher by the amount of the manager's salary. The reason you do that is SDE is assuming the owner is also the manager in the business. And so therefore the owner is not only getting the income from the business that it produces, but also the manager's salary. And so SDE is usually used for, like I said, smaller size businesses, simply because most businesses that make less than $500,000 a year, the vast majority of them are both owned and managed by the same person. Okay, so from EBITDA, EBIT, and SDE, the tricky part is we have to now make adjustments in most cases. And the reason we have to make adjustments is sometimes owners will run a lot of personal expenses through the business. For example, maybe they have their car owned and paid for by the company, their cell phone, maybe they take the family on a trip around the world, perhaps perhaps, and it's all paid for by the company. These expenses are not legitimate expenses to the business itself, so it doesn't actually represent the true cash flow the business is producing. And so in those cases, we have to actually add back those expenses to the EBITDA numbers or EBIT or whatnot in order to get a better idea of what the true cash flow in the business is. On the other hand, we will have cases in which sellers have added back things to the cash flow number that actually need to truly be subtracted in order to get true cash flow. For example, I have come across a few cases where they launched a product, they spent a lot of money on the advertising, and let's say it failed. And so they felt justified because it failed in adding back the advertising expense, let's say, they had for that product. Unfortunately, launching products that fail later is just a normal cost of business for most industries. In that case, we had to subtract what they had added back to the cash flow number in order to get a true representation of what the true cash flow numbers were. So again, cash flow is basically what you can put in your pocket after all the expenses, and the tricky part is you've got to figure out and make sure you really know what those expenses are in order to properly evaluate a business for acquisition. Please like this video and subscribe if you found this pretty helpful and interesting, and I thank you for watching.